right, good. Well, I don't even know I don't know when people are watching. So it might be morning, might be afternoon, might be evening. So we'll just say, hope you're having a great day. Welcome to the No Name Podcast yet, which we did not get into last week, guys. We got to figure out a name for this thing. So
I think we have a couple of popular choices if Spring wants to let us know what we got going on.
We do. Okay. Do you want me to start from the top?
Yeah.
how many are there?
Oh, there's a few. Right,
Let's
probably
just
five. Let's
give
stick to the
okay,
five
let's
good.
give five good ones and
Okay.
let's find out what happens.
My favorite one is uncharted territory because Ryan conquers like the unknown in the trading world, so it's uncharted. The next one, here's a fun one if we're doing TradeHound all the time. It's the barking lot. There's one that we chose, I think it was called Money Heist. And then Money Diver was another one, which would be fun. Because you're diving into how to make money. And do you remember another one, Ben?
Boy, these aren't like itching the part of my brain that says, "Oh yeah, that's a good
Well, No Name seems to be
one."
hitting
No,
for you, the
no.
No Name
I mean,
podcast.
we can do a no name. We can call it no name.
That might not be
So
bad.
what about something about Trailblazer, right?
Trailblazer.
Yeah, like Trailblaze.
It's a good car. A good old Chevy Trailblazer, man. It's old school, right?
Like what those two guys that went off into. We're not going to even. Those two
Blazing
guys that went off
Trails.
up into the Great Northwest. Oh, come
Blazing
on.
Trails.
Come on. The
Hmm.
Explorers. They're two names, very
Talking about
famous. I just can't think of their
the
names.
Oregon
Oh,
Trail.
Lewis and Clark?
Lewis and
Lewis and
Clark.
Clark.
Thank you. See, at least one of us has
Trailblazer
some
is a
sort of.
car. They are not blazing through the
Okay, so
trails.
what were they called? What were they called? Uh,
Pioneers, frontiersmen.
Frontiermen, explorers.
all right, guys. Well, we're gonna let the users throw something in the comment box and say, "Hey, this is a good name," and let's see if we can't name this. Oh, let's say in the next year. So, all right, what do we got on the schedule for today? I know we want to talk about. We talked about a little bit about cash flow covered calls last time. We talked a little about TradeHound, which we've made some more progress with, so we can put that on the list. What else? What else? Oh, first calendar day that we just passed. And what did you just bring up, Ben?
With
The
non-farm payroll. Yeah,
oh,
that
that's
was
right, the government
interesting.
shutdown.
Yes.
Yeah.
So I don't know if any of you were any trades at all, but yeah, the reaction to that was odd because the news didn't come out that the shutdown was actually going to delay that release. And normally that comes out the first Friday of every month, which obviously was going to be today. I'd imagine that's going to come out whenever this shutdown is done, and who knows when that's going to be. But that did make the options market an interesting scenario before the close yesterday, at least by what I was looking at. It was crazy. Entered in a trade that I wasn't expecting to do at least hit target in less than a day. But yeah, it was pretty nuts. So I guess they did what they wanted to do with premium at the open, and things were just kind of wild. But
Yeah, so they kept the volatility high as if it was gonna come out,
right,
and then they made the announcement and just kind of cut the knees off of everybody out from there.
really fast. Because
Yeah.
normally when you have like these non-farm payroll days, as you know, they always kind of like they wait till like maybe late morning into noon until they start, siphoning out any of that volatility. At least by what I see, if I get out of any trades on Friday, which by the way, you guys should know, always generally to get out, Thursday towards the end of day on most of these type of trades. But sometimes I'll hold into Friday morning if my short strikes are tight enough and I'm not dealing with a dead zone, right? But yeah, it was definitely weird because it was basically the same reaction you would get if you were within a profit peak towards the middle to end of the day, but it was right in the morning for me. It was pretty weird.
Mm,
So
mm.
It's pretty instantaneous, and that was for Monday. It was next week's expiration. I did it for. So, but
So
yeah,
did they give a date on when they're going to release it, or just
no,
whenever
I
the
think
government comes back online?
yeah, it's supposed to
Yeah.
be based on entirely on when the government comes back online here.
So what do y'all think
Um,
about that? What do y'all think about the government going down or shutting down? I mean, it's happened like how many times over the last 20 years?
I've lost
It's
count, to be
it's
quite
it's almost
honest.
like it's almost like you
Yeah.
count on it anymore.
Right,
Yeah, I think the market's forward looking and it's already discounted that. And
right.
I've never noticed it to be an issue. I mean, you can Google it or put it in AI and it'll kind of explain how insignificant it really is.
I think
Yeah.
people
The broad
think there's a
market.
reaction, but there really isn't.
I think when if I my memory serves me correctly, it's been a while now, like maybe 6, 7, 8 years, I don't know.
Yeah.
But there was a government shutdown, and it actually did affect the market.
Yeah.
Like people were concerned. What was it, for like
Was,
2 weeks or something?
yeah, like maybe a 15% sell off. Does that sound
Was
too
it
deep?
that much? I don't
God,
remember it being that much, but that was the only
that's
time. And then you look at the market. They shut down. When was it? Wednesday or Thursday of last week?
okay.
Do y'all remember?
No, I don't remember
Um,
Well, the market's
actually, wasn't
the
it?
market went surging to new highs today, and the government shut down. So that kind of tells you what the market thinks about it.
So has it
Right.
been that
Like,
case for the past 20 years every time it shuts down?
no, but guess what we're going to do when TradeHound gets fully functional?
yeah.
We're going to analyze that
We're going to
data.
give you those
We're gonna
stats.
the data will
Love
be in there.
it.
Actually,
Uh,
that
so-
is interesting you mentioned that because there's so many little small catalysts. It'd be interesting to see what makes the market have a knee-jerk reaction versus not. So yeah, that would be
yeah.
Right.
interesting to see.
Yeah, well, I've always said it's the unknown. If there's anything that's unknown, that's what's going to create the volatility. That's what's going to create the market selling off a little bit or negative news. But the unknown is what people fear the most, and that's what drives
Indeed.
a market moving down. So apparently they weren't fearful on this. Now
Right.
we did come off those highs. It went surging to new highs today. Came off about an hour ago, and now it's kind of rebounded just a little bit to basically a break even for the day. So
Right.
I just, quite frankly, wouldn't bother me if they stayed shut down for a while.
Right.
I
That's
I've
don't
not
know.
always
your
wondered.
feedback, though.
It just shows if we can go with the government shutdown for a week or 2 weeks and we're fine,
Right.
makes you wonder how much we actually need.
Hey, do you guys still get mail?
Mail, mail.
Like, because I always hear that,
Yes.
right.
That's a
Okay,
Yeah.
good
so I
question,
always hear,
actually.
Yeah.
yeah, I always
I need
hear
to
that's
check.
like during your government shutdowns, like you get no mail. I'm like, I don't know, man. I just went out yesterday,
Oh,
mail
you
was
mean
there.
I thought you meant ever.
USPS.
No, 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 right.
You are so facetious.
Well, I
It's
mean,
like, Ben, that's
everything's
a dumb
digital.
question. What are you doing, bud?
Right?
Everything's digital. I mean, when's the last time y'all printed something out?
The other day.
Um,
I
for
have
me,
kids.
it's gonna been a minute.
Yeah. Yeah. That's kind of where we're going with that.
Yeah.
So where do you think what do y'all think's going to happen here? We in SPY,
Okay.
I got it. Do what, Chad?
No. Oh, I was going to ask what your question was. Sorry. You're
Oh.
saying it now.
In SPY, we hit all the way up to what was the high today? About 670, almost 673.
Yep.
And now we're just under 670. And obviously all-time highs again. I mean, it's been ridiculous. I've been doing my live trade calls in September, and I'm like, be ready for a little bit of a sell-off, be ready for a little bit of sell, and it never came. We didn't even get 2 down days during
Yeah,
September.
man. Yeah.
Insane. And I think we mentioned that last week, but I'm still pretty ticked about it because I do best when there's just a little bit of a break about once a week. That's all I need.
Right.
And clean house. But when you don't get a break for eons, so like today, one of my positions had a $4,000 swing.
Wow.
Oh.
because that's all I need is a little bit of a break. Now it's given some of that back, but if it stays right here, because it's based on time, most of it. If it stays right here, I'll make all of it back.
What strategy are you trading with that one?
It's a hybrid cash flow option insanity
That's what I
trade.
thought of. Insanity.
Yeah. So what I do is I don't remember if I mentioned this last week or not, but I put on a certain type of trade that has very, very, very little risk if the market stays the same or moves higher. But if the market moves down, it doesn't have to move down very much. I'm going to make like 4 to 5 times what my risk is. And sometimes I can actually make a little bit of money if the market stays the same or moves up. Not always, but that's one of the things that I like playing because stocks are sideways 50% of the time.
Mm.
So y'all have no opinion on what October is going to bring for us. I think we need to put
Nice
our
weather.
reputations on the line.
No. Pause. Who is the preacher of you cannot predict the market? You don't know.
This is what this exercise is for. We're going to prove to everybody that you can't predict the market. Let's go. Go, Ben. What do you
Well,
think?
you know what's
Up or
interesting about that? Before I get into my pick right here, looking at just monthly data, right? And this is what's going to be really interesting about TradeHound. You could look at, and this data would be very easy to even kind of siphon through because you could look at how many consecutive monthly positive months you could look at and what the market has done in a row to the upside. Now, if you look at a monthly on the Qs, for example, we're on month 7. This is starting October. If she closes
7 months
higher,
in a row.
it would be 6 already. So if she does it in
Already.
October, it would be 7. And that, at least in my career, I'm not that old, but at least in my career, is pretty unheard of. So I'm going to guess that the market is going to close lower in October.
You know what we should do?
We should
We
take
should
a
put that
poll.
in Trade Partner, and I mean in TradeHound.
Yes.
Find out on a monthly basis the maximum consecutive number of months that the market has moved up.
And the probabilities of a 7th month in a row.
It's 50-50 no matter how many times it's been doing it. But
right. But if you have
if you want to be
probabilities
true
on your
statistics.
side.
So you're saying down. Big down, small down?
I'm gonna say, honestly, I think we need to test. Here, let me pull off.
But about 2/3 of the time, October's up, going back to 1950.
We need to test on the Qs. I watch the Qs quite a bit. Let me pull up SPX here. We need to be in the ballpark around 6,600 come the end of October for any kind of rally, in my opinion, into the holiday season. We have to be around that area. If we're above that, I really don't see a holiday rally coming in, but we need to be around 6,600. That's my call on SPX.
Okay. All right. Chad, what's your call?
Just if we rally into the end of October, I think we do.
Okay, so you think we're up by
I think the market's risk on.
I think you might be right, and which sucks for me. But
spring is going to be the decider here.
No,
I love the best
I haven't
thing
said what I'm going to think it's going to happen.
Go ahead. I think it's going to be up. It's always up. Every time you think it's going to be down, it's up. So I'm banking on consistency.
You know why
what Ryan says it's going to be, it is the opposite.
Wow.
Hey, at least you still make money.
Yeah.
So, you know why we don't worry about it here? Because we know to go long and hedge.
Yep.
Properly.
That's right.
Yep.
That's right.
So we don't care.
That's exactly right, Chad. I
Hey,
don't
Ryan's
care.
course, he kind of knows what he's talking about in that regard.
You know, if
there's other ways to do it, but he does it probably a more efficient way, I think.
So my call, I'm looking at the chart.
Yeah.
You know, and I'm a reversion to the means guy.
Yep.
Come on, yes. Ryan has had some sense.
I think we
they have no idea what's coming on with TradeHound, do they, Ryan?
No, they don't.
We can, there's some ideas.
I think we drop to about 650 in SPY.
Boom.
Yeah.
Good man.
And we
650
we
each buy.
already know it's not going to happen now.
But I'm gonna give my butt.
Yeah.
In that, um, if it happens in the middle of the month, I think we rally at the end of the month.
I agree.
Okay.
I agree.
You can't do
So
that. You can't
No, I
have
do. No,
both.
really.
I
No,
just
that's
did.
kind of without convoluting things. The market is definitely bullish. If we, it depends on the speed. If we get this any kind of movement down before the end of the month, he's absolutely right. The
Yeah.
market will find some support in that level.
Yeah.
I
Well,
So
you swung $4,000 today. I mean, it's gonna.
no, that's just my position.
Okay.
I had a position that went from it was losing a little bit to up 4, and now it's back to about 2. So I will make if the market stays the same, no matter what. When I put this position on, if the market stayed the same, I'd make $2,500 or down. If the market moved up a little bit, I'd make a little bit more. If the market moved up too much, I'd lose a little bit. So I didn't need but that's the thing is I don't need the market to go up. I just need a little bit of back and forth, and I'm good on that. So
You need some balanced accumulation and distribution, is what it's called, Ryan. You need a nice balanced market that's not crazy.
Oh,
Even then, though, honestly, I think a lot of you that have gotten Ryan's strategies, even in a crazy market, which we love, we welcome when there's that increase in volatility. That's always fun.
Mhm.
that's where the opportunities are the best.
Absolutely.
You can still eke the stuff out, but when the volatility is higher like this, option insanity is it's
Same.
the way to go.
Hence the name.
It's the way to go. Yeah, hence the name. The opportunities are insane. So it just depends on what's going on. And I think that's where most index option traders kind of miss the boat a little bit, is that they don't realize that there are different types of opportunities and different VIX levels. So they trade the same thing every time, or they try to trade the same thing, or they want to trade the same thing every time, and it doesn't
Mhm.
exist every single time. They can't get the same price, so maybe they put in a little bit worse of a price, et cetera, et cetera. But you've got to acknowledge the change in volatility, which,
Okay.
by the way, is always down when the market's going up.
I have a question.
Yeah.
So you've created, right, 25 plus strategies, who knows, over your time.
How about
250,000.
yeah?
Variations.
How about
Anyways,
over 1,000?
it's wild. So when you're watching the market because you don't care what the market's doing, but you do because you're using it to tell yourself, okay, I'm going to use this strategy versus this strategy versus this strategy. How do you because obviously you're very experienced, but how do you on the fly decide, okay, which one am I going to use based on what the market's doing this week?
Pricing of the spreads is always the determining factor. Either I get my price or I don't. And if I don't take the trade, or I do something else.
Of
What
that.
does Ryan mean by that? What does Ryan mean by pricing of the spreads?
That's a great question, Chad. So, for example, in my cash flow spreads, I'll do what's called a Twin Peaks. And we do a report on Twin Peaks. We should put that in the link, the Twin Peaks report in the link. I do a report on Twin Peaks. And when volatility is low, the structure, it's a spread, it's a diagonal spread. And the structure is that you have 2 shorts and 2 longs. And the shorts have got to be closer together in low volatility. In higher volatility, you can spread them out. But in low volatility, you gotta have them pretty close. And so what I will do is I will tighten that spread up a little bit, and then I will require a credit on the spread. So if none of my spreads are at a credit, I'm going to wait till they turn into a credit, or I'm not going to get into the trade. So that's the spread pricing dictates, because every spread that you get into is directly affected. The win-loss ratio is directly affected by the price that you get in. So if you have $1,000 risk on a spread, and you're able to get into it at a $500 better price, then obviously your risk only goes to $500 at that point, right? So the better pricing you get for the spread, the better off you're going to be. And I think that's part of the secret. That's also why I have the freedom codes for the cash flow and the $1 million pattern spreads, is because generally 315 to about 345, the best time to get in the afternoon into those spreads. And it's not always that way, but again and again and again, I can't tell you how many spreads. We're not going for big profits on these things. This is high probability, low profit. But there'll be times where I get in at like 325, and by 4 o'clock I'm out. I've taken my target, and boom. That's how
Same day.
different. Same day.
Same
Yeah.
day. Wow.
That's how much the volatility changes during the last hour. It goes down and then back up towards the close. And you see that pretty consistently. So if it's little things like that kind of give you a little bit more of an edge, so that you can better time the trades, get better prices. Like, for example, at 3 o'clock, my spread might be at a 10-cent credit. Okay, it's credit. Looks great. By 3:30, that thing might be at a 50 or 75-cent credit. And then by 4, it might be at a 25-cent debit. Right, so I make $100 in a half hour. But if I had bought 30 minutes, earlier, then my profit is only like $30 an hour later. So you're not gonna pick the absolute low of a spread price, and you're not gonna get out at the absolute high. I mean, it's rare that you're ever going to do that. But any little help, any little edge, definitely helps with that.
So I could throw all of that information, or say, into TradeHound, and I can say, hey, find me the most consistent time at the lowest rate on the close, and then find me the most consistent time at the highest. And could I base a strategy around that?
So that's a great question. You would have to ask TradeHound for a 5-minute by 5-minute analysis of the VIX during the day. And then you'd have to couple it with the price action, because, so for example, today, going into the 3 o'clock hour, the market come off the highs, significantly off the highs. We were at like 663 or 673, and then we come down to below 670. Right, so we dropped 3 points in less than an hour, basically, in SPY. So going into the 3 o'clock hour, the market is down, and that's when volatility goes up. You see it spike a little bit. It's not a massive spike, but it depends. It correlates with the move down. And then once it stops, then you see the volatility come back down. And now the market bounced a little bit during the 3 o'clock hour here, and it was like perfect time to get back in or into a spread. But if that down move is happening at the time that I said the volatility is usually the best, then that may not be the case. So there has to be this correlation between the market action and the time of day before you can just say absolutely yes or no. But yes, we will be able to do that in TradeHound, but that one is going to require intraday data, which we don't have hooked up yet. And so we're probably looking at 3 or 4 months before we get to that.
And one other thing to keep in mind, because we get this question asked quite a bit, especially with getting in and out of that type of trade, is do you have to be worried about pattern day trader rules? And I will say that first off, I think it's dumb. I've always thought this rule was super dumb, but we can't do anything about it until somebody with some sort of gumption comes in there and gets rid of it. But to answer your question, guys, for the type of trade that Ryan did, where he got in at say 3 o'clock, 3:15 rather, and got out before that closed, that is considered one round turn, and that is considered a day trade, right? He's allowed 3 of those within a 5 session trading. So if he does that 2 more times within 5 trading sessions, then he would be flagged as a pattern day trader and would require 25,000 in his account minimum and maintain that balance and higher. Now, if you got in, because a lot of people wonder, well, how do I do this and still take advantage of similar spreads? You can get in at the close or near the close and then look for your exits on the next trading day. That's how you avoid the pattern day trader rule. So if you enter and exit around turn on the same session, that is a day trade. If you can get in on one day and out on another, you're good. You're golden.
Or you just take 3 a week.
Or what?
Or you
You
just take 3 a week.
3 a week.
Is it 3 that triggers it, or is it more than
It's 3 that, yeah, you can't
I
go
think
beyond
it's
that.
Oh, so you can only take 2.
No, you can take 3.
No, you can
but
take
can't-
3.
You can't
It's
do
the
a fourth.
4th one that triggers
Okay.
it.
Yes.
Yeah.
Yeah.
You know, and that's an interesting rule. I think it's ridiculous. Long story short, but if you've got an absolutely limited risk trade, absolutely capped, I don't know where the risk lie that much.
Yeah.
So I just don't understand
Yeah, it's the exchange.
Yeah.
Exchange makes that rule.
Yeah.
And they're just, I try and tell people the exchange is not, because a lot of people, especially in the futures market, they tend to use the leverage that's available in the futures market, right? And that leverage is given by the exchange for a reason. And that reason is so that they will maximize their money based on whatever risk degree that they have, with people's positions, right? So they give you margin, so you can trade leverage like tenfold in a commodity or futures market, and people will max that out. And I tell people, listen, the exchange did not give those margin rules for you to make money. They made the margin rules for them to make money. So ignore it. And that's the same thing with pattern day trading. They think somehow, and there are some people that abuse it. Right there, they got a $5,000 account and they're maxed out all the time. They're trading in and out 50 times a day. Right? That's who it's for. But the fact that they can't make exceptions is a real pain in the rear end on things like an absolute limited simple option spread.
Right. They should just loosen. Honestly, if anyone's listening that has any power to change that rule, just loosen it. Just loosen it.
I assure you they will not.
They could loosen it to say, I don't know, 30 in a month or something, 30 around 30 in a month.
Yeah.
But yeah, so we get that question a lot.
Oh, so all right, so we've got our market analysis in, which is absolutely worthless.
You're welcome for wasting your time.
It'll be interesting. No, it's to prove a point. It's at the end of the day, it's 50-50. Actually, it's 56% probability that the market goes up. That's what it is.
Correct.
No, it's 100% based on your analysis. I'm going to keep this up.
Okay. All right. Perfect. Well, I saw your college pick'ems.
No, I knew you were going to bring this up.
and let me tell you, I'm embarrassed that you're my daughter.
Listen,
I'm just gonna say.
You guys got to understand, I got a lot going on around here. I don't have any time to do any kind of data research on college football. All I want to know is OU going to win? And if they're not,
Boomer. That's right. That's right.
But really, no, what I do for college pick'ems is I go, boop, 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 boop. Okay, I'm good. Those are my picks.
If I remember correctly, Spring's system, which was fascinating to me, was that you would look at the mascot.
Yeah.
Wasn't that right, Spring? And you would decide
when we did it with the company. Yes.
which
I was like,
mascot.
that one looks cool.
Exactly. Hey, you were doing well though.
And that's why I'm a Steelers fan. At 4 years old, they are kicking tail, and I love their helmet. So at 4 years old, I become a Steelers fan.
Sometimes I choose all of the Catholic schools just for fun. And then sometimes I choose the Mormon schools on college pick'ems. I just do categories sometimes. I'm like, SMU, no, I'm going to choose this one because they're this. I don't know.
You were 1 and 9 last week.
What was yours? What was yours?
1 and 9.
Oh, there you go.
Embarrassing.
Like daughter, like father. There you go.
It was a rough week last week. That was a really,
but
really bad one.
You were like third from last in the entire group, and I'm at
I know
least
I
like
lost
15.
my touch. This year, I don't have my touch.
Yeah,
Last year,
okay.
like I was rolling in the top 10 of the group, and I did the same thing. Boop, 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 boop.
Yeah.
Okay, I'm good.
Well, you don't. Yeah, Chad's like you, only Tennessee. He doesn't care about anything
True.
except Tennessee.
Should be a good game in Knoxville. For the Sooners coming down.
Where's my
It's in
ticket?
Knoxville, right? Yeah.
I think
Yeah.
it is this year. Yeah.
Yeah, I think Oklahoma comes to Tennessee.
Yeah. Where's my ticket? Where's my box seat?
Hey, give me a minute. We'll see what happens. I will try.
Well, if he
Uh,
gets one, I want it.
You down, yeah, down.
Ben might as well come on too.
Right?
Yeah.
Might as well. Why not?
All right, let's get to we mentioned something in the last call, cash flow covered calls. And I don't remember everything that we said about it, but I do remember that I said I was going to bring on somebody, one of my clients' trades that he sent me. And I haven't gotten an update, but this was like in August, and since then, so he's taken cash flow covered calls in Tesla. And that's not the best stock in the world to do a cash flow covered calls. We're not going to get into that today as to why. But Tesla is super volatile. And so back in late February is when I started redoing that course. And I said, hey, we're going to start doing this in Tesla just so that you can see how it works, because Tesla is pretty volatile. And at the same time, you really don't get that great of prices on the option spreads for Tesla. So it's not the best stock in the world. And immediately, like the first trade that we took, it dropped like from 410 to 330. Tesla stock, 410 to 330.
Ooh.
Yeah, 25% drop almost, right? 25% drop in a very short period of time. And I had said, conventional covered calls is where you buy the stock and then you sell an option, either at the money, out of the money. Sometimes people do it slightly in the money, so they're grabbing a little extrinsic value and they're giving themselves a little bit of a buffer to move down. But if the stock tanks 25%, you're toast.
Yeah.
I mean, it's just you're going to be sitting there with that stock forever, because you can't do anything else because you're sitting on a massive loss, right? So there's an issue with the win-loss ratio. The only thing, and so this is what people say, is you only do covered calls on stocks you want to own. That is the conventional wisdom. You can Google it. They'll say it again and again and again and again and again. And this is kind of what Spring was saying earlier. I question everything. And I'm like, that just doesn't.
And remember, it's phase two of the wheel.
Sense.
You remember that, the wheel strategy, basic wheel strategy. It's phase two.
That's what I was about to bring up.
A wheel strategy. So, they're all tied together in that regard. And I agree with you.
Yeah.
Well, what it sounds to me is like they say, well, you just better bank on losing.
Well, no. What they're saying is if the stock goes down, you're in for the long haul until it comes back up. Right. So yeah,
so
I guess
right
prepare for losing. Yeah, I guess
sounds like a bad strategy to me.
I mean, that's the typical stock strategy, no matter what, is if you buy a long-term strategy anyway. So anyway, what we do is we don't do a long stock, we do a long option. And I'm not going to get into details because I go through it. It's like a 5 or 6 hour course, and it's not difficult, but I'm thorough. And so what we do is we don't buy the underlying stock, we buy a different option, and we allow for the time decay to work. We allow for the price market, the price to move up and make a little bit more. But if the market tanks 25%, we don't take a massive hit. Okay, so that's number one. That's the first reason why you don't want to do a conventional covered call, is the risk reward is just not worth it. And by the way, when you sell the option, you're capping your gain on a move higher. So if the market skyrockets 25% and you sold, an option that's 1% out of the money, guess what you make? A little over 1%. So maybe 2%. Some from the option, some from the price of the market. So it's just skewed. So we buy an option and we sell an option, and we play the time decay difference against one another, or synergistic, actually. And so when the market tanks, the second big thing, actually this would be third now since I mentioned the capped movement up, but the third big thing is that when the market moves down like that, you can't sell another call, because then you're locking in your loss. And so you have to sit on it until it goes back up to about break even. Then you can start selling calls again against it. And so if you get into a stock, like for example, it was at 410 in February, when we started to do this at the very beginning of February, 410. It dropped all the way. First, it dropped to 330. And then about a week later, it resumed the drop and went all the way to 220. In fact, you know what? I'm gonna share my screen here.
I was about to
This
say
is
it's
really
probably
important.
better for a visual
Yeah.
on that, because the move was quite large. And
Yeah.
Yeah.
It was
if you
quite
start,
large.
if you're buying at the highs, that's never fun.
Yeah. So I'm gonna do this here. Let me share my screen. All right, so this is Tesla. And I'm just gonna pump this
What's
out
the
here.
date there, Ryan?
I'm gonna pull it
Oh,
down.
okay.
There you go.
SP. Okay.
So here's
Yep,
where
okay.
we started the strategy right here.
Yep.
All right. Immediate move down to 325 here. Then you pop up a little bit, and then a massive move down to 220. All right. So if I start a conventional covered call right here, and the market drops like it does, right? I make money on my call. I lose money on my stock, but I can't sell another call until the market moves back up here because they're not worth anything. And so what happens is I can sell a call here, but then if the market moves back up here, I lock in a loss in my stock.
Yeah.
It's ridiculous, right? But then the market took another dive. And so let's say we got in conventional covered call right here, starting in February, and we can't start selling calls again. Look how long you're sitting on this stock until it moves back up to about 400. It just did that at the beginning of September. Now you can start selling calls, and guess what? Market moved way up, and now you did not participate in this move higher with your stock, which means now if you put it on again up here, now you lose the value of your stock that you did not gain, and you only get the price on the call option. Conventional covered calls is one of the worst trades that people can make, and it is one of the most popular. So it's no bueno. All right, so what I'm going to do is I'm going to show you one of my clients began trading this, and he sent me the trades back in early August. So so these trades don't even include the money that he made on the calls on the way up here. I should probably get an update from him on that, but this is what it is. All right, now what you want to pay attention to here, this is what he's up, $3,575 on Tesla. When Tesla, so about right here, he's up $3,750. And Tesla's barely higher now. And Tesla, obviously went in a massive drawdown. So here's his first trade that he took, looks like March. First trade, -60. Second trade, 475. Third, 400. 570. Negative 80. Plus 581, plus 248. These are actual fills, by the way. Negative 209, 440, 645, 1385. Here's the biggest loss here. It's at 846. 600, 400, 300. There. Oh, this is the biggest loss, 924. And then he made 940 on the next trade. So on any of these big losses, what happens is the market does move down. So there is risk with the cash flow covered call, but when the market moves down, your risk is capped, and it's capped to the debit on the trade. So here is the debit on the trade. So he's risking, instead of the market trading at 270 at this point, at 270, instead of risking $27,000, he's risking a tenth of it. All right. And here the maximum risk is 1,600. Here's 1,700. Here's 1,500. Here's 1,400. So you see the max risk pretty consistent down here. And then on this one, where you see 4,000, it's because he went to a 2-lot. 4,000 here, he went to a 2-lot. So he's implementing a pretty conservative compounding plan and starting to go. And so on here, 2-lot, on here, 2-lot. So on this one, it's actually about 1,500, a little 1,400 a piece, right? So no matter what, the stock can tank $100. It can take $10,000, and you're not going to risk more than 14, 13, 1,400, 1,400. And it has to move down pretty far. If it moves down a little bit, that's what you see here. You don't get a 1-to-1. You actually have some room. So my point is that not only do you cap the loss, but when you take a loss, you can turn around and you can take another trade because you're not worried about the stock having to move back up before you just take the loss, and you know that on the next trade you can make up that loss. Or it might take 2 trades to make up that loss, or whatever the case is. So the market comes down. Here's probably where he lost one of the bigger ones. Market moves down in the trade. Even though this from here to here, let's see, 355 down to 271, so 75,000 or $7,500 move down, and he only lost $900. If you're in a conventional covered call, you're stuck until the market moves up. It did move back up, and then you sell a call, and then it moves back down. And then you're stuck, it moves back up. So it can happen that way, but it depends on when you start. And then, once it goes too much further above where you originally got in, you got to get out. You can't do it anymore because you're risking way more. So that's just a quick analysis of making $3,500 during a pretty volatile period in Tesla, and a lot of wins here in this. So not a lot of drawdown. What's the biggest drawdown? One trade, 846 here, then 924 here, and immediately he is back out of it. So this is 11. He exited this one on July 11th. 1 week later, he makes it back up. And if you're in a covered call position or conventional covered call position, you can't even take the trade after you take this kind of loss. So questions?
Yeah. Did he happen to show you what he was doing February? Because it'd be interesting to know, because this is on end of March, which is kind of towards that.
Yeah, I thought I may have gotten another one that he started in February.
Right.
So I need to look, because I have several clients who sent me their trades.
Right.
And I may be so I think there's another one that started in February who started off with a loss, like $1,500 loss, almost the maximum amount. It took him 2 trades to make it back, and then he very similar to this. So unfortunately he doesn't have anything there that.
Gotcha. Yeah, so anyone watching, just so you know, even if he has, let's say he just happened to have 2, 3 losers in a row, you're still reducing your drawdown by so much
Yes. Yeah.
versus just holding on to the stock and praying for the best.
Yeah.
You
Yeah.
know, it gives you options, no pun intended, in your
And
position.
and you are still capping the potential gain,
Right.
right? But you can if the stock skyrockets, you can still put on another position because your risk is going to be the same or very similar no matter what.
I mean, you're
And
capping
yeah,
your upside in a conventional cover call anyway. So
exactly. So that's kind of the 10-minute lesson for the day, I guess, on that.
I think it's awesome to see in action how it doesn't matter if you have a loss or the consistency of taking the trades, that you can see, okay, this is a quality strategy right here. When
Yeah.
you compare it to what Tesla actually did in the market, I mean, that is really cool.
Yeah. It's not perfect. There's no perfect strategy. It's not the holy grail. You're just putting the odds in your favor and you're being consistent with putting the odds in your favor. And it's like the house.
Yeah.
They're going to lose some, but ultimately people keep playing, the numbers work out, and the house wins almost every time.
got to stick with it, guys. You got to stick with it.
Gotta stick with it. Gotta stick with it.
If
So
it's good.
we also have a scan. Did I show that?
Mm-mm.
I should probably show that too. Uh, hang on. Let me pull that up real
The
quick.
covered call scans.
Yeah, the covered call scans.
I had we had a slight tweak to that too, which was nice.
Let's see here. So, oh, you had a tweak to it?
Yeah, I had the sorting more efficient to what we were doing when we initially had these out. So now we've done even more of the work for you guys. So when you get these scans, you'll be able to, at a better glance, see which opportunities pop out to you a little bit better.
Yeah, and I'm going to show this with the caveat that you got to check the prices because these options have large bid-ask spreads, and sometimes the quote is not correct with regard to what you'll actually be filled at because of how wide this bid-ask spread. So it's just a matter of double checking. Let's see. All right, so here it is. Cash flow covered calls, and we're looking out at 1017. We can actually look at 1010, I guess. And you'll notice here, so Adobe, I love Adobe. I love
Yeah,
Adobe.
yeah.
I think it's a great trade right now.
Fantastic. Got Pepsi there too. Lucid. Got some good
Yeah. Yep.
Hmm.
So what you'll notice here, the debit, that's the risk on these trades. Now it's not necessarily the best one. This is kind of more of like to show you which stocks are providing the opportunities. I go into details on picking exactly the right options. And it's not difficult, but half the work is done when you see the stock and it's just a matter of, okay, is that the exact option spread I want to trade, or is there something else? Is there something a little bit different? So on this one, the debit, $500 in Adobe. I will probably go a little bit bigger on the risk on that one, personally. But it's $500 debit. The potential gain is 467, and that's if the market stays stagnant. So you have the time value, and your gain is half of what your maximum risk is if the market makes a pretty decent move to the downside. So you see 87% risk. Again, it might not be, that debit might be a little bit bigger than what that's showing, but you have two of them right in a row, so that might be okay. But I sort these. This is 10 to $500. I sort based on return on risk, and I'll often, like, for example, where'd my chart go? I have 6 screens, guys, and I lose things all the time. Adobe. I'm actually long Adobe.
I like it.
Oh, I love it.
I,
I'm
I'm
actually long
sorry, dude. I
Adobe.
hope I didn't jinx you, but I
Oh,
like
it
it.
doesn't matter if it
I'd
moves
get
down,
buy
I'm buying
side.
more.
I'd get buy side on it.
Yeah, if it moves down, I'm buying more. So, but you got to understand, I have a very small, I have a very diversified portfolio. So when I buy more, I'm not like loading the boat. So no matter what any one of my stocks does, it's not going to hurt me.
Right.
So this is Adobe. This is kind of give it a little bit longer. You can see going back down to 2022, we're almost at the 2022 lows. From a seasonal standpoint, let me
Yep.
pull up the seasonal on this as well.
Looks like, yeah, that's interesting. Decent play there. Let's see.
Whoops, I had a super seasonals window open, but I can't find it, so I'll just open it again.
Yeah.
All right, so
I can tell you if you want. You looking it up, Ryan?
yeah, I want to show
Okay.
everybody. So this is
Okay.
super
Yeah.
seasonals in case somebody wants to subscribe to super seasonals, which by the way is just fantastic. So we're gonna go Adobe, right?
Yep.
We're just gonna do a search, then we're gonna come down here, and it's gonna show us this. All right, so what this is this is the seasonal chart. And you can see here 10-2, we're about where the low is, and on a seasonal basis, it looks very good. But from a yearly basis, this has moved up 74% of the time by an average of 31%, going back to 1987. That's insane. That's an insanely good stock to be in. And with the market where it is right now, tremendous. So on this one, we can tighten that up a little bit and just kind of see that's about the same. So here, over the next 2 or 3 months, it's up about 75% of the time, and the annualized return during that time is almost 59%. The average is about 10% over the next 2 months is what the average has been in Adobe, and that's regardless of whether the market is up or down. And so as you can see, it's been down, and it's been down for a while. So it's not a gimme, it's not a guarantee, but I really like where it's at. And again, there is a sign. So this is actually kind of a bearish pattern. What you see here, when you see a low and a move higher, and then another low, but it doesn't surpass this one, and then a move higher, and then it pops down again. There's actually a pretty good shot of the market breaking this low, and it's like a last gasp. And so we might see that. We might see a last gasp here. I would say, maybe down to 320-ish. And at that point, I'm not going to load the boat, but I'm definitely adding to the position at that point. So it's not a lock, but from here, we're trading at 350. 380 is an easy target in the next couple of months for Adobe. So yeah, you can play it this way. So you give yourself more room to the downside, and you're going to make a decent profit, very low risk, decent profit if the market stays the same, or you can do some sort of combination. And by the way, you can tweak the stock, you can tweak the strikes just to be a little bit more bullish. If you put them up a little bit above the market, you're a little bit more bullish. You put them a little bit below the market, you're giving yourself more room for the market to move down, and you still make money. Is how that works for the cash flow covered calls if you want to try and do that. But this is the scan. You can get on board with the scan as well. We talk about a lot of products in this thing, and we should probably, what we should do? We should probably stick a special, like all-inclusive subscription, like a 1-year subscription to like almost everything we have, just for the YouTube, just for the podcast listeners. Not even email it out, but just those who watch the podcast, they have that shot. We should think about doing that. Stick a link.
I can get it put together.
Yeah.
Yep.
Yeah.
Actually, one other interesting thing, Ryan, could you pull up that scan real quick again?
Hey, I just
Yeah.
wanted to tell you too that see, am I muted? No.
No.
Seasonally speaking, over the next month of trading, roughly, if you go back to the last 10 years, you might have what's called a recency bias. Yeah, the average mean move is about 11 or 12% in October for Adobe.
Hmm.
Doesn't
Yeah.
mean it's going to do it. That's high point. Sorry, average high point move.
Yeah,
Average high point.
which is shown in the super seasonals.
Right. I'm
Yeah.
diving deep into the app. So I'm
Yeah.
going into the month. Like if Ryan scrolled down to the month of October,
Oh
uh,
yeah.
October, call it second week of October, I think I'm looking at. And you can digest into these weeks if you want to get into the micro level. Yeah, I
Yeah.
think that's the one
So
I looked
detailed
at, Ryan.
report, right?
Yep, you got it. So
Yeah.
yeah, just that's
Let's
you got a
see.
10-8 star. So
Look at Microsoft.
yeah,
That's a nice seasonal right there.
yeah,
Uh,
you can really geek out on this stuff. So
yeah.
you know
Yeah.
what I mean.
Yep.
And then you're going to
So,
be in like every single stock that you find.
yeah, right.
Like
Yeah.
this one's a good one too.
Yeah, I mean, all it's saying is that the software has found a pattern that might exhibit a tendency for the stock to move. And like I
Yeah.
said, the average mean high point is 12% in a month, which is, I don't know what the risk or just, I mean, annualized return on that, what's that, 144% annualized?
Yeah, that's pretty good.
Pretty stupid. So.
So here's the
Oh,
scans up again.
yeah. So I wanted to point out one thing that I think a lot of people forget, which is
Mhm.
super important, is that if you look at Adobe, great stock, but it's $346, right? So if you
Yep.
wanted to do a covered call on that thing, you got to put up 30 grand.
Yep.
And you got to get 100 shares, but you can leverage your money a lot more effectively by doing a spread.
Yep.
And the same thing
Yep.
holds true for Tesla. You're tying up a large, I mean, depending, of course, on the size of your account, but it's still a lot of money regardless, to put into one stock, just to tie it up when you could leverage your money and get sizable returns
Yeah.
on any kind of move up. So that's just one thing I wanted to point out, because you're looking at a $500 risk or 533, 870, $1,300 risk on Adobe for these positions, and there's no way you're going to be able to. I mean, you can get in, obviously, if you bought a share or two, right?
Yeah.
But you're not doing a covered call. You're not doing anything like that. You can't sell any premium against that until you're at least one contract worth. So,
Yeah.
it's definitely a far cry from putting up 30 grand versus
Yeah.
1,300.
Now,
Absolutely. And I might be wrong, Chad. Maybe you can look this up, but I think Adobe might have an earnings report coming up.
they might. I was looking at my chart. Hey, Ryan, a question. Assume I'm a novice because I don't know who's on this podcast or going to be
Yep.
listening to
Yep.
this. Wouldn't I always want to take the highest return on the risk trades, Ryan?
So if it's real, that's maybe.
Right. Maybe. Right. So,
Maybe.
so the market's given me 35% return on risk. Is it because there's higher odds of that happening?
So,
Or,
no,
I mean, they're going to
no.
give me 87%, but what are my risks? So I'm starting to think a little deeper as a trader, but as a novice, if I were to go tell my dad or mom, they'd be like, I'm doing that 87% return on risk. Why wouldn't I?
Yeah.
So is there a little more to it? Or how do you look at it, Ryan? For if there was a beginner?
So you can actually put one of these on that have like maybe a 125% return on risk just by putting it a little out of the money. Right. So you can
Right.
skew these numbers by where you put the spread relative where the market is.
Right.
And if it's if you put it a little bit lower, you're not going to get as big of a return, but you have a wider range where you're going to make money. Like you're giving yourself a little bit more down room. The market can actually move down a little bit more, and you're still going to break even or make a little bit of money than if you were to put on the one that's a little bit more bullish. So if I'm bullish, like I am with Adobe, I'm probably going to go a little bit higher on the strikes and actually get a little bit better
Yep.
return on risk. And I don't care, by the way, I don't care about earnings on these.
The earnings was on the 11th of September, actually. So it passed already.
Okay.
There you have it.
Okay. Yeah.
There you have it. So then the next question is, can we really get filled at this debit? I can tell you as soon as we get done here, which will be fairly quickly, I'm going to go and look.
Run it through the matrix. Run it through the matrix, guys.
Yeah. So, all right, let me pull that. Oh. All right. So there's our hopefully valuable information for the week.
I think it had tons of information. That was
Yeah.
that was very high trader-esque this week. So fun.
All my Tao subscribers out there, congrats! You guys had another winner. Really happy.
Do tell us a little bit about that, by the way.
So we had we closed out. We basically trade mostly the Qs. Sometimes we'll do SPY, but we just closed out another winner yesterday. We closed out of that combo. So we do a bullish and a bearish, and then we manage accordingly. That one we didn't have to manage because I had them leading a little bit more bullish, and we got out on that run yesterday at the close. And this year actually is doing quite strong. So we're happy all around. I know we get occasional guys coming in and giving me the comments. I love you guys. I love you all. Appreciate it. But Tao's going strong, so it's a good program.
Awesome.
Did you start
So
new? Did
What
you
was that?
start new on a 5K or are you revolving with what you're building?
Yeah, no, we continue it. Anybody that comes in new, you guys will always have the compounding plan, so you can start from 5 because you'll see how we transition down to where we're at now. But I also keep a column that shows non-compounded returns. If you just didn't have, the the confidence to compound at all, you could stick with one lot and you're still at pretty decent gains with this.
So can you tell us the difference year to date of what they've been making
Didn't
market
pull up
down?
the. I think we're at.
and these are actual fills, by the way,
Yes.
right? So these we
yes.
don't report fake fill.
And on top of that, I always tell anyone. We had a gentleman who was looking to join the program, and he was asking how accurate would the results be versus a new member. And I told him always just lop off a third of what you see, and that'll get you a good idea. And that includes trader mistakes, that includes fees, commissions, whatever it is that you want to pile in there, and you're going to be okay because the third is fairly good chunk of profit. So we started 2025 on the compounded account at roughly $7,900, and we were at an 11 lot. And as of today, we're at $27,000 on a 25 lot.
Nice.
So there's the power of low risk because your trades are low risk, right?
Absolutely.
It's a variation. So explain what they are. Is it a variation of cash flow and what?
Yes. So what we're putting on is we give ourselves a bit of a bankroll to work with, right? So we'll put on a bearish, and because we can't go out on multi-legged diagonal spreads more than really a week and a half to 2 weeks, just because of the expiration is not being available on Friday to Monday, we'll put on, say, like a broken wing butterfly that'll give us a fat credit, and with that, we'll put on cash flow bullish spreads to offset any upside risk. So the bearish is going to give us a bank for roughly about 3 weeks. And then I will put on a bullish cash flow trade, generally bullish to neutral, depending on kind of the outlook what we're looking at. But I'll put on a bullish trade on there. If we get a move down, we'll close out the bullish and we'll hold on to the bearish, and then we'll roll at lower strikes. And basically what you're looking at, like we had our last loser was $25 per lot. The one before that was $65 per lot. The one before that was $11, $39. 110 was our largest one. Volatility was a bit higher.
That's the
on that
largest
one.
loss.
Yeah, this year per lot. No, the largest was on January 8th, beginning of the year, 158 per lot.
That's it. $158 has been your largest
Yep.
loss this year.
And our largest winner was right after that. Our very next trade, we won $387 per lot.
Nice.
And so you've taken through compounding and consistency 7,900 to 20 what? 27?
27.5.
So $20,000
Yep.
on the
And
year
we
so
started
far.
at, and last year we had started. So here's what's interesting about and beautiful thing about compounding, right? It really speeds up once you start getting into lot sizes. And sometimes we
Yeah.
do play. We haven't played SPX actually this entire year. We played SPX last year, and I found that a lot of the subscribers just preferred the Qs
Yeah.
and
Yeah.
spies. So we just kind of got away from the SPX, which is totally fine by me. And but even then, we had some really decent returns last year because the account had gone from 7,000 to 9,500, and then we had a drawdown at the beginning of the year, which was that 158 that we saw, and then from there it just started moving really high. The lot size just started really compounding quite quickly. So I was
Awesome.
thinking about just kind of pausing it there at 30 and just starting fresh. Uh,
Which
I
you
don't
can
think
do,
you should.
right?
I think you should show us how far you can bring it.
Well, you know, the way it's keeping it realistic because it starts becoming more of a mind game when you start piling on those lots.
Okay, here's a
So
suggestion.
yeah, okay,
Take 5 grand from your winnings
all right,
and do 2 different ones. So we can
yeah,
see
No, that's a good idea.
how
Except
how
that's a good
big it
idea.
can
it's
grow.
good. So the great thing about the way that you're doing it is they actually, if they have trade partner, they actually get the signals in trade partner. So all they have to do is
Yep.
click, yeah, push trade, make this trade.
We actually omitted that. We forgot that. Yeah, so
Yeah,
you
yeah,
get the trade exactly from me. Now, if you're trading a larger lot size, that's the only thing that you're going to have to adjust. So if you are compounding your account, I'm going to send it to you as a one lot, right?
yeah,
So you would change the ratio that what you're trading at. So if you're at a 10 lot, you go ahead and change to the 10 lot. And from there, you're going to hear what I'm getting out. You're going to hear whatever management. You're going to get that notification out there to you guys. And I send that pretty much, actually, honestly, I send that right when I get filled, if not sometimes before I even get filled on the exit or management on what we're doing. Because latency is a killer sometimes, and the markets can move fast. But I try to make sure that the positions that we're in, even on management, that even if the market decides to do something crazy, it's not going to be this huge discrepancy on where I got out or in versus where my members are getting out and in because that could be super annoying.
yeah,
Uh,
yeah.
but yeah, it's definitely it's
So
definitely
I think we should spend some time on that next in the next podcast.
yeah,
Yeah.
it'll be great.
Yeah,
But
just
you didn't.
show them trade partner, show them one of the trades,
Yeah.
show them the track record.
Yeah.
You know, don't give them all the information, but show them the track record.
So you didn't mention what the difference of your compounded versus non-compounded, what the
Oh yeah.
amount.
So are we still on the record here?
Yes.
Here we go. Where'd it go? Ah, here we go. Right. I have so
And
many.
I think this is gonna surprise a lot of people.
I
Yeah.
have yeah. I have like 10 spreadsheets up in here. Oh, okay, here we
Yeah,
go.
yeah.
So for the beginning of the year, on the non-compounded, that started at $7,600, 7,610 to be exact, and is currently trading at 89.35.
Wow.
And
Wow.
the same account
That is
compounded
gross.
is that 78.26 is where it started at for the compounded, and it's currently at 27,593.
People
That's
have
okay.
no clue how powerful compounding is on a low risk strategy.
Yeah,
Yeah,
No
the
that's
clue.
more
Indeed.
the less, this might be a subject too we could talk about. The less risk you have, the more aggressive you can be with the compounding.
Yes.
That'll be a subject
As a
for
general
Ryan to
rule.
touch on
Yeah.
maybe.
Yeah.
So,
There's you know what's interesting about compounding in general, especially early on in my career,
yeah.
especially Ryan, when I came across your information on compounding, is that you can tweak it depending on your strategy. Now, if you have a high
Exactly.
win rate strategy, you can tweak your compounding to reflect that. If you have a strategy that wins, which we kind of touched on the last
Mm.
call, the 50-50 thing, some guys can trade
Yeah,
it.
yeah. Yep.
Some can, you could tweak your compounding that way as well. 60, whatever it is, you can be as aggressive as you want with your compounding and taking that into consideration. So,
You just have to be able to handle the hit when you do have a losing week.
right,
Yep.
right.
Yep.
which we traded out of in this program. Even just looking at different drawdowns that we've had for this year, we had 4 losers in a row from 2020, from February, end of February to March, middle of March. And that's kind of when the market started doing its craziness anyway. Because I lean us bullish with pretty much all of our trades. But here's what's interesting. We did have a loser. It was actually supposed to be a loser, and we ended up breaking even on it. And that's when the market was moving down pretty fast. We ended up closing that out. I called it a scratch. We actually made a little bit of money, but in terms of commission fees, errors, I just made it a scratch. But we actually made a little bit of money on that.
And that's because they popped the volatility up on that move down, isn't it?
Yep.
Yep.
And it's just about that management, guys. When you give yourself flexibility to manage your trades, you give yourself that opportunity to be right. And that's pretty much what we do with the Tau. We get you guys into trades that have that higher probability. But if we're wrong, we can adjust and hold on to that bankroll for as long as we need. So, and anything that we've ever lost on was on something that was just, I mean, the market just went boom immediately. Like we basically ended the spread, at the top of a move before it went down. And at that point, there's really nothing that you can do. But our losses are always limited, and that's kind of the key.
Yeah. Yep.
Yeah.
So we have a pretty big list that we are going to need to touch on in the next podcast. So we should probably bring this one to a close. Markets are about to close, and I need to go tend to some trades. So
On that note, all right.
yeah. So guys, hope you enjoyed today's podcast with, I can't think of any funny names to call you guys. I'll have to pre-think that one in.
Hey,
I'll
we
probably-
can leave it to the audience as well. You guys can think
You
of
guys
the
are
names of
just
the
the
podcast.
hooligans.
Remember,
All
I
right.
love you guys all, but
And don't forget to give your name suggestions in the comments, like and subscribe.
There you go.
You
All
too.
right. Ben, Spring, Chad, and Ryan are signing off. We'll see you guys next week.
Wait.